They didn't warn you. They never do. Right now, as you read this, the two nations that have financially backed America's entire way of life for the last 4 decades are quietly, methodically, and simultaneously pulling their money out of US Treasury bonds. And the number they moved in a single month will stop you cold. $81 billion gone in 30 days. Japan sold $27 billion. China shed $9.6 billion, dropping its holdings to levels not seen since 2009. The UK quietly offloaded another $44 billion on top of that. 1 month, 3 nations, $81 billion out the door. If your financial advisor hasn't called you about this yet, there's a reason. And by the end of this video, you'll understand exactly what that reason costs you every single month. If this is the kind of structural financial intelligence you need delivered to you daily, not weekly, not monthly, hit subscribe right now. We track the global bond market every single day, so you don't have to watch your retirement quietly erode while everyone around you is distracted by headlines that don't matter. Here's what you need to understand first, because the headline number is alarming, but the machinery underneath it is where your real financial life is being decided. The US Treasury market is the single largest bond market on the planet. $27 trillion in publicly held debt, $36 trillion in total national debt. And that entire system runs on one non-negotiable requirement. There must always be enough buyers willing to absorb the new bonds Washington issues every single quarter to finance the gap between what it spends and what it collects in taxes. For decades, that buyer base had two anchors, Japan and China. At their combined peak, they held close to $2.5 trillion in American government debt. They weren't just investors. They were the structural reason the United States could borrow cheaply, run persistent deficits, fund the world's most powerful military, and maintain its social safety net at the same time. That structural foundation is now being actively dismantled, and the pace is not slowing, it is accelerating. Drop a comment right now before you keep watching. Did you know that Japan and China were both reducing their US Treasury holdings at the same time? Tell me honestly, did anyone in your financial circle warn you this was happening? Your answer matters more than you think. Start with December 2024 because that single month was the most concentrated foreign exodus from US Treasuries in recent financial history. Japan sold $27.3 billion in 30 days alone. China shed $9.6 billion in the same window. The UK moved $44 billion out. 3 nations, 1 month, $81 billion. And the Federal Reserve was simultaneously offloading $60 billion per month through its own quantitative tightening program. Combined, that is over $140 billion in selling pressure hitting the Treasury market in a single month against a backdrop of $2 trillion in annual deficit financing needs. That is not noise in the data. That is a structural stress test happening in real time right now, with your mortgage rate and your retirement account sitting directly in its path. Now, here's the part almost nobody is telling you, and it is the piece that reframes this entire story. China's official Treasury holdings show a drop from $1.2 trillion at peak to under $760 billion today, a 37% reduction. But that number almost certainly understates what is actually happening. China does not hold all of its US Treasury positions inside the United States. A significant portion flows through custodial accounts in Belgium and Luxembourg, 2 small European nations whose reported Treasury holdings are wildly disproportionate to the size of their economies. Belgium currently shows approximately $481 billion in US Treasury holdings. Luxembourg shows approximately $425 billion. Those figures are economically impossible for those domestic markets to generate. They are Chinese reserves parked in European custodial infrastructure, a deliberate architectural choice that gives Beijing the ability to hold and sell treasuries with reduced visibility to U.S. tracking systems. The U.S. Treasury Department's own documentation acknowledges this custodial bias explicitly. What this means is that the official China figure of $760 billion likely overstates how much Beijing actually intends to keep, and any selling flowing through Belgian or Luxembourg custodians is completely invisible in the headline numbers you see reported. In early 2026, Chinese regulators issued a quiet directive to the country's state-owned banks: reduce your concentration in U.S. Treasury securities. This was not a press conference announcement. It surfaced through internal banking sector reporting. And by November 2025, China's Treasury holdings had dropped to $618.2 billion, the lowest level since September 2008. The direction is not ambiguous. And simultaneously, this is the critical move that tells you everything about Beijing's actual strategy. China's gold reserves hit 74.15 million ounces at the end of December 2025. The People's Bank of China has now been buying gold for 17 consecutive months. Beijing is not rotating out of US debt and into euros or yen. It is rotating into gold, hard assets, assets that cannot be frozen, cannot be sanctioned, and cannot be tracked through Western financial infrastructure. Philip Wool, Chief Research Officer at Rayliant Global Advisors, said directly that the shift to gold is being discussed with increasing frequency in institutional circles, driven by fears the U.S. continues exploiting the dollar's reserve status as a geopolitical weapon. That framing is precise. China watched what happened to Russia in February 2022. $300 billion in Russian foreign exchange reserves, much of it held in Western financial systems, frozen overnight by coordinated G7 action. The lesson Beijing absorbed was institutional and explicit. Any reserve held in U.S. Treasuries, in U.S. correspondent banks, or in Western custodial infrastructure is ultimately subject to American financial jurisdiction. Gold held in Beijing is not. So the calculation becomes simple. Reduce Treasury exposure, accumulate gold, shrink the attack surface that U.S. sanctions could target in any future confrontation. This is not paranoia. It is rational reserve management given a demonstrated real-world precedent. And it is happening right now, at scale, in plain sight. Now here is the side of this story that carries the most immediate financial consequence for ordinary Americans. And it is not China. It is Japan. Japan is the single largest foreign holder of U.S. Treasury bonds on Earth. Over $1 trillion as of the most recent data, nearly double China's official position. And Japan's relationship with U.S. Treasuries is being fundamentally altered, not by politics, but by mathematics. The Bank of Japan has been raising interest rates after 3 decades of zero and negative rate policy. Japan's 40-year government bond yield hit an all-time record of 3.689% in 2026. Its 30-year hit 3.436%, levels not seen since 1999. Every single maturity on Japan's yield curve is now at multi-decade highs. And that creates a direct financial incentive, completely independent of any geopolitical decision, for Japanese institutional investors to bring capital home. A Japanese pension fund or life insurer that can now earn 3.689% on a 40-year domestic bond, denominated in yen, with zero currency risk, has an increasingly weak argument for maintaining large U.S. Treasury positions that expose it to dollar-yen currency fluctuation on top of yield considerations. Japan sold $25.6 billion in U.S. Treasuries in December 2024. In the 2 weeks following the April 2025 tariff announcement, Japanese investors sold over $20 billion more in foreign bonds, with U.S. Treasuries representing the majority of those positions. The 10-year Treasury yield spiked to 4.592% during that episode, the largest weekly yield increase since 2001. The S&P 500 fell 12% across 4 trading sessions, and a 90-day tariff pause was announced within 72 hours. The bond market did not negotiate. It moved. Because Japan, the largest foreign creditor the United States has ever had, started selling at scale in response to domestic yield dynamics that Washington has no policy lever to reverse. Goldman Sachs quantified the transmission mechanism precisely. Every 10 basis point increase in Japanese government bond yields pushes U.S., European, and U.K. bond yields higher by 2 to 3 basis points automatically through capital flow dynamics. Japan's 10-year yield has risen 70 basis points over the past 12 months. Run the calculation. That is a 14 to 21 basis point upward pressure on every American mortgage rate, every corporate borrowing cost, every car loan, transmitted from Tokyo into American household finances without a single congressional vote or Federal Reserve decision. On a $400,000 mortgage, a 20 basis point increase in the underlying rate adds approximately $50 to $80 to your monthly payment, permanently. That is the cost of Japan's domestic monetary policy landing on your kitchen table through the Treasury market, and there is no political solution being offered to stop it. The broader pattern is confirmed globally. Brazil's Treasury holdings dropped from $229 billion in November 2024 to $168 billion by November 2025. India's fell from $234 billion to $186.5 billion over the same period. Saudi Arabia is diversifying reserves toward gold and yuan-denominated instruments. The foreign creditor base that financed American deficit spending for 4 decades is contracting simultaneously across its most important members. And the U.S. deficit is not contracting with it. It is expanding. The national debt is approaching $39 trillion. Annual interest payments on that debt have now exceeded $1 trillion for the first time in American history. $1 trillion every single year just in interest, before a single dollar is spent on defense, infrastructure, Social Security, or Medicare. That number surpassed U.S. military spending in 2024. It surpassed Medicaid spending. It is now the largest single budget line item. And every basis point increase in Treasury yields driven by Japan and China reducing their buyer presence adds billions more to that annual burden automatically, as existing bonds mature and must be refinanced at current rates. Approximately $9 trillion in U.S. Treasury debt is maturing and requiring rollover in 2025 alone, being rolled into a market where the 2 largest traditional foreign buyers are simultaneously pulling back. Now let's address the counter-argument with full honesty, because this analysis has to be accurate, not alarmist. Treasury Secretary Scott Bessent has dismissed suggestions that China is weaponizing its Treasury holdings as overstated. TD Securities strategist Prashant Nunaha argued in April 2025 that targeted Chinese selling should concentrate pressure at the front end of the yield curve, but the April sell-off was concentrated at the long end, the 30-year and 20-year maturities, suggesting broader investor reallocation rather than surgical Chinese action. That is a credible and important distinction. And the Belgium and Luxembourg custodial routing argument means that China's apparent decline in holdings may partially reflect a geographic restructuring of where those assets are held, rather than outright liquidation. If you adjust for custodial accounts, China's true Treasury position may be closer to its 2011 levels than the headline $760 billion implies. These counter-arguments matter, and they deserve to be heard. But they do not neutralize the structural concern. They refine it. Whether Beijing is liquidating outright or restructuring custodial geography, the directional intent is identical. China is reducing its visible, sanctionable exposure to U.S. financial infrastructure. It is accumulating gold as the alternative store of value. It is building yuan-denominated trade settlement infrastructure through CIPS, all 3 simultaneously. Which means even if the Treasury selling is partially overstated, the strategic withdrawal from dollar-denominated reserve assets is real, verified, and accelerating. Here is the constraint that makes the current environment categorically different from every previous Treasury stress episode. The Federal Reserve is the buyer of last resort for U.S. Treasuries. When foreign demand weakens and primary dealers struggle to absorb auction supply, the Fed can step in through quantitative easing, buying Treasuries to suppress yields and stabilize the market. It did exactly this in March 2020. It did it through multiple rounds of QE between 2008 and 2021. But today, the Fed is running quantitative tightening, actively reducing its balance sheet by approximately $60 billion per month, because inflation remains above its 2% target after cumulative price increases of over 20% since 2021. If it reverses course and launches a new round of QE to compensate for reduced Japanese and Chinese Treasury demand, it risks reigniting the inflation that American households are still recovering from. The Fed is caught in a direct conflict between its inflation mandate and its role as the financial system's emergency stabilizer. It cannot fully serve both simultaneously. And that conflict is precisely what the simultaneous withdrawal of Japan and China is exposing, whether through deliberate geopolitical strategy or through independent economic incentives that happen to converge at the worst possible moment for American borrowers. Bill Gross, the founder of PIMCO and one of the most decorated bond investors in history, stated publicly in 2025 that the era of the United States borrowing at artificially suppressed rates because of its reserve currency status is drawing toward a structural endpoint. Ray Dalio, founder of Bridgewater Associates, has framed this as the late stage of the long-term debt cycle, a period where accumulated debt reaches a level that structurally erodes confidence in the currency and the bonds denominated in it. His historical analysis of reserve currency transitions, from the Dutch guilder to the British pound to the US dollar, identifies falling foreign demand for government debt as one of the most reliable leading indicators of the transition phase. Japan and China reducing their treasury holdings simultaneously, gold hitting record highs, the dollar's share of global reserves falling from 73% to 57% over 2 decades. These are not unrelated data points. This is the pattern Dalio has been documenting for a decade, now playing out in real time across the most consequential bond market on Earth. The most direct financial consequence for you, stated precisely. The 30-year fixed mortgage rate is priced off the 10-year Treasury yield. In 2021, the average 30-year mortgage rate was 2.96%. By late 2023, it had reached 7.79%. It has remained persistently elevated, hovering between 6.5% and 7.5% through 2025 and into 2026, despite Federal Reserve rate cuts. The reason mortgage rates have not followed Fed cuts downward is the exact dynamic described in this video. The Fed controls short-term rates. Long-term Treasury yields are controlled by global supply and demand. When Japan reduces its Treasury buying because domestic yields are now more attractive at home, and China reduces its buying because regulators have directed banks to cut exposure, the long end of the Treasury curve faces structural selling pressure that the Fed's short-term rate decisions simply cannot offset. Your mortgage rate is not controlled by the Federal Reserve. It is controlled by the global appetite for American debt. And that appetite among the 2 nations that anchored it most reliably for 4 decades is measurably, verifiably, and simultaneously declining. Foreign ownership of US Treasuries peaked above 50% of total publicly held debt during the 2008 financial crisis. As of early 2026, that share has fallen to approximately 30%. The foreign ownership base has nearly halved in less than 2 decades. The deficit requiring financing has more than doubled in the same period. That gap is being filled by domestic buyers demanding higher yields, and by a Federal Reserve constrained from acting freely by the inflation it is still fighting. Both of those filling mechanisms carry inflationary consequences that land directly on American households. The $81 billion that left the U.S. Treasury market in December 2024 is not the number that should keep you up at night. The number is $9 trillion. The volume of U.S. debt maturing and requiring refinancing in 2025 alone, being rolled over into a market where the 2 largest traditional buyers are pulling back in unison, where domestic replacements demand higher yields, where the Fed is handcuffed by inflation, where your mortgage rate, your retirement account, and your government's cost of borrowing are all navigating the same structural headwind simultaneously. This is the financial environment you are living inside right now, and it is not improving. If this gave you something your financial advisor hasn't, share this video with someone who holds a mortgage or is watching a 401k. They need to understand what is moving the numbers before the numbers move them. And if you're not already following this channel for daily coverage of the structural shifts that move your economy before they reach your bank account, now is the time. We track this every single day. Subscribe so you never miss what the headlines bury,